But markets still digesting last week's Fed decision and looking ahead to the December meeting. Our next guest views the over-tightening as significant in a risk for the future economic growth. For more, we welcome in BlackRock's Global Allocation Team Head of Thematic Strategy, Kate Moore. Kate, great to have you here with us this morning. First and foremost, when we think about the Fed, and given that last week's move was widely anticipated, what is the next data point from your perspective that the Fed would actually give some weight to?
Yeah, I think there are a couple things. Obviously, we need a couple more payrolls reports. We need a couple more inflation reports. And I think there's going to be a real close monitoring of even higher frequency economic activity. What's happening to retail sales? How are companies talking about their inventories into the holidays? But I have to say, this is an incredibly difficult job the Fed, and frankly, any central banker, any policymaker has ahead of them right now. We know that most economies in the world are slowing, the U.S. slowing much less than others. But at the same time, we're not quite at an inflection point. And we're waiting for the real effect of higher interest rates to be really felt by both consumers and companies, which really hasn't happened yet. We are still holding strong in an expanding economy. And so it's a challenge to say, should we pause at this moment and wait and see exactly what happens in terms of higher rates impact, or should we, proceed?
Kate, how should an investor know when that inflection point happens?
Well, I think that's the trillion-dollar question, which I wish I could tell you exactly what investors should do in the moment. But I'll tell you what we're doing, which has been, we've been holding higher levels of cash than we had historically, both because, frankly, we can get, solid yields on our cash, as well as we're looking for opportunities to add to high quality companies that kind of get washed out in terms of their prices as people get worried about recession. There's some areas like semiconductors, for example, that are definitely on our shopping list at this point. But I think it's smart to be more cautious and to wait a little bit until we get through the next couple Fed meetings and the next series of economic data. And very importantly, and I know this is a while away and feels like an eternity for most investors, what companies say when they report fourth quarter earnings, which won't happen until the beginning of next year. What does their 2023 guidance really look like?
And for some of those companies, they've either had to be real about their guidance or just pull it in entirety. And so we've seen tech specifically have to really navigate through a challenging period, and that could mean headcount reductions. That could also mean pulling some of the guidance as well in the future. Where do you anticipate, at least at a kind of forward price to earnings ratio, perhaps, that the theme of tech might be a little bit more appealing?
Yeah, this is a great question. And you're right. As we were listening to companies report the third quarter earnings, a massive message was CEOs, CFOs, management teams in general didn't have any better insight into the exact path of the economy than anyone else. And so as a result, they were either holding back guidance or offering fairly conservative guidance to what the street may have wanted. And I think that's actually a smart move, even though often that level of conservatism was punished in the market. In terms of where we have to hit valuation wise, I think that's your question, Brad, where we would need to get to, what is the trigger point? I don't think there's a magic number. A lot depends on, frankly, where we go in terms of policy rate and whether or not the next move after getting to some level is up or down. And by this, I mean, does the Fed pause? How long do they pause for? Are they going to readjust their expectations during that pause to perhaps raise again in the back half of next year or to cut? The one thing I will say is, it's really easy to look at history and expect multiples or trying to forecast multiples to go back to a long-term historic average. Unfortunately, a million things are different between these examples in history and today, not just like the composition of the market, which companies are the biggest parts of the market cap, and what their balance sheets and their growth prospects are relative to the last time we were looking at index multiple levels, but also, consumer balance sheets, the labor market, the geopolitical environment, the overall fiscal policy environment. All of these things are meaningfully different than in historical periods. So I would love to say we can just go back and say at 14 times, that's the long-term median for the S&P, that's where we should, sort of settle. I just don't think that's going to be so simple.
Kate, I caught a lot of flack from the team for already starting to think about 2023, but I'm sure your team is already thinking about potential themes for next year for investors? Any ones that are starting to catch your attention?
Yeah, I mean, there are a few. Look, within the technology space, I would say there has been some bad feelings, either around enterprise spending or around the semiconductor side, perhaps being oversupplied after a period of scarcity. But we do think that demand for many of these components and demand for software is going to remain really robust over the medium term. So I think that's a place that we're digging into and look to add risk next year. I also am really constructive on a lot of the resource side. You know, we've seen energy and materials get sort of move around aggressively with expectations around Chinese growth or expectations around global growth. But the truth of the matter is many of these materials, whether we're talking about industrial metals or oil, have a pretty tight supply-demand balance. So I think resources are going to be an important theme over the medium term as well. And we would look to continue to hold. We're pretty overweight at this point, but also add next year. And finally, I would say in the consumer, everyone is worried about overall consumer spending, but there are some very strong consumer companies, services, experiences that we think will continue to be strong in 2023, even if the overall economy slows. So I'd say these three pockets, you know, technology, kind of the industrial demand and resources, and also consumer. Not all is lost, even if I'm pretty cautious at the moment.
Awesome insight as always. Kate Moore, BlackRock Global Allocation Team, Head of Thematic Strategies. We'll talk to you soon. Thanks so much.
Thanks.